Hey everybody, I want to thank you for joining us for another live stream. We're here every week, 1 p.m. Eastern Time. Thank you for joining us here at Let's Talk Money, and we've got a really special, really important video for you today. One that I think a lot of people and a lot of people are talking about the trade war, talking about how it's affecting stocks, and waiting for it to be over. And the thing is, this is going to be one of the themes that is going to take us through probably the next decade. And we're going to talk about that. We're going to talk about how this trade war is actually becoming the next Cold War. And the two sectors that it's really going to affect and really going to determine, how you invest, even for those long-term gains. I know a lot of investors here are long-term investors. They want to just buy and hold, maybe even the stock market as a whole. But given the development in this new Cold War with China, that's not going to be. I don't think that's going to be possible. You really have to strategically invest your money in these two sectors that we're going to be talking about, but as well as across some other sectors as well. So I see a lot of people joining in. Derek, Ocean Mist, Lou Viva La Vie, Del King, thank you for joining us. Everybody, thank you for joining us again. We're here every Sunday, 1 p.m. Eastern, and I want to get started here because, like I said, this is going to be a very important topic for your investing over the next years. Probably over the next decade. This developing Cold War with China and how it's going to affect your investments. I want to thank you again, though, for joining us. I always love these live streams because it gives me a chance to really talk with you back and forth with everybody out there in the community. Don't really get too much of a chance to do that in the regular videos, but I love talking to you, answering your questions, and really having this back and forth. So as long as you keep on showing up and asking these great questions that I see, then we'll keep doing these live streams. But we want to get started, and for those of you that are new to the live streams that we do every week, I'd like to start out with a few community shout outs, just talking about some of the comments that we received over the last week. Always get some great comments, and I want to share those and share the answers to the most important ones, the ones that I think are going to help drive your financial future the most. We also highlight a few of the videos from last week and a few of the videos coming up this week. What to look for, what are some of the most important points. Veronica says, habla español. Yes, I actually live in Medellin, Colombia now. Iowa born and raised, but moved down here with my family. Good afternoon. Hey, everybody. Julian, thank you for joining us here. So we're going to talk about, do a few of those comment shout outs. Highlight some of the videos, but then we're going to get right into that, how to invest for the trade war, because like I said, this is probably one of the biggest themes I've seen developing in a long time. I worked for about a decade as an equity analyst for venture capital, private wealth managers, and I did well. You can do really well analyzing stocks, but one of the most important things you can do as an investor is to notice these large macro themes, these large forces. There are these trending forces that are taking control and are going to guide the markets. And that when you do that, you don't have to pick individual stocks. I'm going to show you two sectors that are really going to be influenced by this developing Cold War with China. And once you have that theme down, once you recognize that theme developing, then you just go in and look for best of breed stocks within those sectors. You don't have to pick a great stock. You don't have to pick one company out of the entire stock market, the entire Russell index, or even the S&P 500 companies. You can narrow it down, pick the best of breeds within the sectors that we'll talk about, and then maybe some other sectors to hedge that. And that's how you get those returns. That's really how I produced those returns for my venture capital clients, my private wealth clients when I was an equity analyst. Find those large overarching themes that are controlling everything. And like we've seen, just the development of the trade war itself has really been guiding the market, and a lot of the stocks affected. But it's like I said, it's really developing into a larger Cold War atmosphere that we're going to see develop over this next decade. So I want to get right into it. Of course, we always have question and answer at the end of the live stream. I love talking back and forth with everyone out there, and we want to get to that. But I want to get to our comments. over the last week. And again, I answer all the comments on the videos. Love hearing from everyone out there and really having that back and forth. But I want to highlight a few comments that I got this last week. Some really great questions. Sarkis asks, is REIT investment wise during a recession or a slowdown? And which sector of REITs will be most defensive? And it's a great question. Everyone knows out there. Raji, see you in there. Everyone knows that I love real estate. Got my start as a commercial real estate analyst in college. I've managed my own portfolio of rental properties and, have analyzed some of these REITs. And there's no sector, there's no investment that has created as much legacy wealth, as much family wealth as real estate. It's really something that every investor needs in their portfolio. I understand that it's hard getting started because of the large amount of money you need to invest in a particular property. So that's why I love REITs so much. Real estate investment trusts trade just like stocks. You buy them in any investment account, and it's just companies that hold real estate investments, commercial properties, and then they pass through 90% or more of their cash flow to investors. So they're huge dividend returns and a great tax efficient way to hold real estate. But there are some things that you need to watch out for with REITs, and that's what Sarkis is talking about here in this comment. One is interest rates. Any investment that is extremely leveraged. Okay, and real estate's one of those things that is very leveraged. A lot of debt used to buy real estate. Anytime interest rates go up and down, that's going to affect the investments there. So often you'll see when our interest rates are increasing or rising, usually because the Fed is hiking rates, then REITs will lose some of their value, or they'll have a tough time just because the competition of other rate products, other yielding products. We don't quite have that right now. The Fed went on hold pretty much, and some people are actually calling for a rate hike. Odds are about 50-50 of a rate or a rate cut this year for the rest of the year. If you look at the market odds through trading through futures on interest rates. So you don't have that problem, but obviously this commercial real estate is also very prone to the business cycle. So when a recession hits or when the economy slows down, then people might not be needing some of these types of real estate properties. So it's a great question, and yes, if you are looking at a recession or maybe the economy slowing down, then maybe you do want to readjust your REIT portfolio. Some of the ones that I mentioned here: office, hotel, industrial, a lot of those sectors that are directly affected by the economy. So obviously, if unemployment rises, if the economy slows down, people aren't going to be vacationing quite as much. Maybe they'll vacation closer to home and just stay at home instead of these hotels. So that's going to affect the hotel industry. Industrial activity slows down in a recession, and then office as well. Companies start cutting back on their office payrolls. They're not going to need to rent as much space from these real estate companies. So those are three sectors within REITs that you want to watch out for when a recession comes or when the economy slows. For relative safety, on the other hand, you can look to healthcare REITs that own hospitals and clinics and other things like that. People need healthcare whether it's a recession or not. Also self-storage REITs. It's a little bit more economically sensitive than healthcare because if people lose their jobs, they're not going to be paying for that self-storage. They're just going to store all the stuff in their basement or something, but it's less economically sensitive than a lot of these other REITs. So again, great question. Thank you, Sarkis, for asking that. This next one is about 529 plans, and this is for Mario. Any suggestions for a good way to save money for a kid's future? And he says he's not a fan of 529 plans, which of course my first question was why not? Why don't you love 529 plans? Because there is a lot to love about them. Basically, if you don't know, 529 plans are a special taxable or tax efficient savings account. So it's a special investment savings account that you can set up. Usually you can set it up with a bank or any investing platform. A lot of times we'll set them up. But you set it up, and you, unlike an IRA where you get that immediate tax deduction for your contributions, you don't pay taxes on any money you put in. At 529, you will pay federal income taxes. So it's like a Roth IRA where you don't get that deduction. Okay. Now, if you do live in a state that has an income tax, a lot of times, if you set up your 529 in that state, then you'll get a a tax break on your state income taxes. So that's a great benefit for people like, myself. I live from Iowa. State taxes, I can put money in the 529 in our kids' 529 account and deduct that from our state income taxes. Now, the real power here, though, is when you take the money out. You never pay federal income taxes or state income taxes on any money you take out of that 529 account, and that's all your returns. So you never pay taxes on your returns if you take that out and use it to pay for educational expenses. And the definition of those educational expenses are growing every year, right? Actually, Congress is passing a retirement savings reform package right now. The House passed it. It's going on to the Senate. That is actually might expand some of these uses that you can use for these 529 accounts. So it's very broad, and for the most part, most of us are going to have these educational expenses. Whether it's for our kids, you can pay your own educational expenses with it. They're actually part of that reform package. They're actually talking about being able to pay your student loan debt with these 529 accounts. So tax-free money to be able to pay your debt off is always a good deal. But there are some things that if you don't have an income tax in your state, that kind of takes away some of the benefit. You're still going to always save for those federal income taxes on the return, so I think it's a great plan. But I wanted to talk to you about some other ways to save money for your kids' future that might not have maybe the restrictions that 529 account does. And one of them is a really interesting trick that I learned while working with the rich, with private wealth management. And if you don't know that, I love talking about investing and making money, but if you ever look into the tax filings of the rich, you'll see that the way they make their money is by not paying taxes. That is the number one way that the rich, get richer and grow their wealth is by saving on their taxes that everyone else is paying. Okay, and one of the biggest things here is setting up tax advantage accounts for their kids. Shifting money to their kids. News a few months ago out was that Donald Trump actually received a loan of something like $400 million in today's money from his father through that shifting, and it's all totally legal. It's just this kind of tax loophole stuff that you do. And one of the things you can do is that to shift money to your kids, set them up for their savings, is open a Roth IRA account for them. Okay. And that's a special type of IRA account where you pay taxes now on any money you put in, but any money you take out is completely tax-free. Okay, and this is, I know everybody loves the immediate tax benefit of a traditional IRA, where you take that money out off of your income taxes, off of your income, put it in there, and then you pay taxes when you take it out in retirement, and that's great. But you're paying taxes on those returns when you take that money out. With a Roth IRA, you never pay taxes on those returns. Okay, so you pay taxes on your contributions. That money grows until you take it out in retirement. But then when you take that money out, no taxes on what you put in because you already paid taxes on it, but no taxes on your returns either. Okay, so it's a huge benefit. And what you can do is actually you can make anybody can make up to, I think it's about $6,000 a year without having to file taxes. Okay, you don't have to file taxes if you make less than $6,000 a year. And even if you're paying making a little bit more than that, your taxes are going to be extremely low. So what you can do is you pay your kids. If you have any kind of and basically you can say you have any kind of a business. Okay, you say you have a gardening business or whatever. Pay your kids to help you. Okay, pay your kids to do their chores around the house and things like that. Just pay your kids and put that money into a Roth IRA. Since it's their income, they can put it into a Roth IRA and never have to pay taxes when they take that money out. So it's a great way to save for their retirement. We all the old timers like myself, always wish we got started investing in our 20s, started investing earlier. Well, what if your kids could start investing in their teens or even earlier than that? By shifting some of this money early into a Roth IRA account for them, they'll be guaranteed millionaires by the time they retire. They'll never have to worry about it. So it's a great way to save for your kids' future. They don't have to pay taxes on it since they're not making more than $6,000 a year or so. And it's just a great way. You can also, make it fun. Give them stock each year on their birthday or something like that. I don't know how many toys we've bought our son, over the last few years, and he plays for him all maybe about 30 minutes. So instead of toys, sometimes, buy him a stock, buy him a share of Google or whatever. If you really want to be generous, buy him a share of Amazon worth, what's that, about $2,000 each now. So now I want to talk about real quickly about last week's videos, the videos we got coming up this week, and then we're going to get into that content, into that topic, the investing for the trade war, or what I'm calling it, the new Cold War with China, because this is really the theme I think is going to guide the markets for the next decade at least. This Cold War that's developing with China, how it's going to affect two sectors specifically, and how you can invest behind that. So last week we just finished up our Create a Course series, and this was all about creating an online course to make money on it, and then and then 3 strategies I shared Friday how to sell that course online. This is really the next level for bloggers or anyone wanting to make money online. Like I said, I love talking about investing, but even if you're able to get 10-15% annual returns on investments, it will still not touch the amount of wealth you can create by creating your own businesses, creating your own assets, your own products, like these courses that we talked about. Okay, it's relatively costless to create an online course. So, you need a few resources like a website to put it on and some other things like that. But it costs almost nothing to create a course, sell it online. And I shared my own income from my first course in there. Over just the first 4 months, I made over $9,000 just in the first 4 months. It's growing each month as I build out that sales strategy, and it costs almost nothing to put together. So check those out if you're at all interested in really growing your wealth and creating some of these online assets. Then check those out. Next week, we're going back to some of the basics of personal finance with 2 interviews I've got coming with you. One is just on basic financial literacy tips, how to understand some of these words that the financial media throws at you. And then we're going to be talking about Dave Ramsey's baby steps with a friend of mine that runs a very popular family finance podcast. We're going to be talking to him. He went through the baby steps, learned a lot. He's going to be sharing those, but he's also going to be sharing what he's doing beyond Dave Ramsey's baby steps. So I know, Dave's very popular here on YouTube. The baby steps have helped a lot of people with their finances, but then you get to the end and you're like, okay, so what now? He's got no solution for what you do after those baby steps. So we're going to be sharing, the beyond baby steps that you can start with. I do see some questions coming in. Please ask them at the end of the live stream. I want to get to all of your questions, but I want to get to our topic today, this trade war with China, what's happening, where it's going, and really how to invest around it, because this is so important. We've seen just over the past, since May, beginning of May. I had a video come out that was an update to our 2019 stock market challenge, where I warned people that this was when this trade war and this friction was going to start heating up. It was going to start affecting the market, and we're down about 4% so far. The S&P 500, the stock market challenge portfolio, our portfolio here on Let's Talk Money, is actually only down about 1.5%. Because I shifted into some of those other sectors and assets. So doing relatively better there. But this isn't just about the trade war, and this is something I talked about in the intro, and something you really need to understand here. This is not just a trade war. This is a new Cold War that is happening, and most of you probably weren't around to really experience the Cold War with Russia and the economic implications that had, and some of that other stuff. But this is going to affect the U.S. economy, the global economy, for the next, at least for the rest of this decade and into the next, and probably even farther than that. So you do need to know what's happening, what sectors in the economy it's going to affect most, and how to invest around that. So just to bring you up to date so far. We've been the administration has been negotiating with China as far as some of the things that they see, and rightly so, that China has been, giving preferential treatment to a lot of its state-owned organizations as companies. It's been allegedly It's been accused of stealing property, intellectual property, because basically when you take, when you start a company in China, you have to have, a good share controlling controlling investment by a Chinese company. So it's basically a partnership. You can't own your own company there. And then what happens is a lot of times they'll obviously that Chinese company will learn that intellectual property, those patents, the things that technology transfers and stuff like that, and they'll purportedly steal those secrets. So we've been negotiating back and forth on those, and we've had tariffs. And what happens with those tariffs is that contrary to what a lot of people are thinking, the Chinese aren't paying those tariffs. J.P. Morgan had a research out last week that the vast majority, like 90% of the tariffs, are being paid by U.S. companies. And because when you have a tariff, then it's paid by the people importing it. Okay, the people buying it from the companies in the other country, they're paying it at the ports of entry and so forth. So it's American companies that are paying these tariffs. Now, what happens is a lot of times they'll renegotiate the prices with those other companies, so with these Chinese companies, to lower those prices as well. So, the burden is getting shared a little bit, but what's really happening here is that, we've already seen profit margins come down for U.S. companies, and we're really starting to see this come through. And what's happening is, especially with this last round of tariff hikes that Trump announced, that 25 from 10% to 25% on that, I think it was like $250 billion worth of stuff. More of that is in retail. Before that, it was in a lot of equipment, a lot of stuff that weren't necessarily bought by U.S. consumers. But this next tranche that actually takes effect at the end of this month, so just in a few days here, is really going to affect retail prices, okay? Because one of two things is going to happen, and really probably both of them. One is that companies, the companies importing all this material, all this stuff, are going to have to pay higher prices, okay? So if they don't pass those higher prices on to consumers, which Walmart, a lot of the very big retailers have already said, a lot of the apparel retailers have already said they're going to start doing, but if they don't do that, profit margins come down, okay? And that means earnings come down, which, what are stock prices a function of? Stock prices are a function of those earnings. It's an investment in those earnings. So if earnings come down, stock prices are going to have to come down as well. Now, if they do pass some of those costs, those increased costs on to customers, what's that going to do? Well, inflation. Okay, so not only are overall sales going to come down because people are seeing this inflation, they can't afford to buy as much as they were. Then so all that Fed rate cut that everybody's hoping for, like I said, 50-50 odds right now in the market of a rate cut by the end of the year, that goes away. Because the Fed has two mandates. The Fed has to look at inflation. They have to keep inflation low, and they want to keep unemployment low. Okay, job stability and price stability. Those are the only two things that the Fed is supposed to do. They're not supposed to look at the markets and make sure that the stock market doesn't fall too much. So if we still have decent employment and inflation starts coming up, they might actually increase rates again this year, which would be a huge surprise and would be a huge shock to the market. Even if, so these earnings come down from companies, they start maybe laying off some people, maybe the unemployment rate ticks up a little bit, but we still have this inflation that kind of ties the Fed's hands. They can't cut rates, they can't spur the economy like a lot of investors want them to do. So it's really a bad situation all around for the current state of the trade war. And so now let's go into that though and look at what companies are getting hurt, what companies and sectors are going to be hurt, and really how to invest around this, because like I said, it's much more than just the trade war. Okay, so who's getting hurt the most right now? Agriculture is the biggest loser right now. China buys upwards of a little over a third, I think, of U.S. agricultural commodities. So we're talking corn, soybeans, especially. The president's come out with two packages of agriculture relief, where he's basically just sending out checks to farmers that have been hurt by this. If you look at commodity prices on the CME, on the futures exchange, at multi-year lows, some decade lows on corn prices, soybean prices. So agriculture is really getting hurt bad. heavy equipment, especially ag equipment. So your John Deere, your Caterpillar, a lot of these as well. Besides buying a lot of our agricultural commodities, China is also a big miner. They're mining all the coal and everything they need within their own country. So they need this equipment, mining equipment and ag equipment as well. So they're hurting quite a bit. Apparel has been one of the biggest ones hit, and probably one of the biggest ones to be hit for the rest of the year. Like I said, apparel and a lot of these other retail stocks, U.S. retail stocks, haven't been affected quite so much by the tariffs yet. But with this last tariffs announced, they are going to start getting affected. This last hike to 25% on those on those imports. The company's going to start paying those, and like I said, they're either going to pass those costs on to consumers or they're going to eat them, which means lower earnings or higher inflation, and probably both. They're going to pass some of those costs on to consumers, and they're going to have to eat some of them, which is going to be in lower profit margin as well. And like I said, a lot of companies have already forecast this in their first quarter earnings statements that we saw. Walmart being the biggest one. Inflation is coming, folks. Inflation, higher costs on, and especially those retail and apparel stuff. Now, what we're going to look at though is the next leg. Where is this trade war coming or going? And this is really where it starts getting interesting and a little bit scary, because the next leg to fall, it might be companies that have taken decades to grow their revenue stream in China. China has been one of the fastest developing countries or fastest developing economies in the world for decades, and a lot of companies obviously have gone that way to try to increase their revenues, and that's going to come back to bite them now. With that Chinese, basically the U.S. blacklisted Huawei, which is the seventh largest tech company, I want to say seventh largest tech company in the world, second largest maker of phones, of smartphones in the world, Huawei. Okay, especially in the developing world, basically anywhere outside the U.S., they're pretty much the top smartphone maker. So the U.S. blacklisted Huawei. They've come off of it a little bit, but basically it's keeping a lot of those U.S. Semiconductor and a lot of the U.S. tech firms from supplying Huawei with the components to their phones. For a lot of you, for what you might not know about the Chinese economy is it's almost completely guided by, their companies will import material, import products like semiconductors, like tech input gear and stuff like that. They'll put it together into something and then sell that something. Okay, so Huawei is a huge smartphone maker, but they don't produce a lot of the stuff. They import all their tech components from the U.S., from South Korea, from Japan. So what happened with this Huawei blacklisting is now they're saying Broadcom, Qualcomm, a lot of these semiconductors and a lot of these tech input companies can't sell into Huawei equipment, and that's creating a backlash in China. Obviously it's a national champion, and they actually had a song go viral over this last week that was kind of a nationalistic boycott U.S. products song, and it went viral. So what we're going to see, this next leg of the trade war, is going to be a lot of those companies that sell in China, domestically in China, are going to start getting hit. And we're going to look at which companies have the biggest revenues in China, which ones are going to be affected. Obviously, Apple is going to be a big one. Apple has $45 billion in Chinese sales alone. That's about 20% of their total revenue. So I actually was talking to a few analysts in China, Chinese stocks over the last week, and one of them was saying, frankly, it's almost kind of embarrassing anymore to take out an Apple product, an iPhone out of your pocket in China because of that nationalistic sentiment, and people are really rebelling against some of these U.S. brands. So Apple, 20% of total revenue is from China, and that's going to start getting hurt. I don't think they've disclosed it quite as much as they should, because it's really going to be something to watch. So, but you've got other, other companies that have been in China for a very long time, are obviously American in name and brand. You got Nike, you've got McDonald's, things like that. But I want to look at, so let's look at that, that chart. And I got a chart here from Bloomberg, and it's actually from FactSet Research. Put this chart together of companies with the greatest percentage of their revenue in China. Okay, American companies, and you see here some of these. Skyworks, Qualcomm, Broadcom, all over 50% of their revenue. And these are basically, most of these are tech input companies. So you've got your semiconductors, you've got other things that go into tech things, into an iPhone, that U.S. companies sell to this Chinese manufacturer. And we've seen these just get absolutely smashed over the past few weeks. Okay, as this trade war develops, as it evolves into a Cold War, these companies are going to be the most to get hit, because a big part of their business model is selling these components to companies in China that in turn use those components, put them together into a large finished product, and then import them back into the U.S. Okay, so not only is it more expensive when they import those products back into the U.S. because of those tariffs, but you've got the stigma of buying from a U.S. company in China. So a lot of these companies, like Huawei, like a lot of these domestic Chinese companies that are buying tech components from the U.S. for their products, they're now going to be looking elsewhere for their components. And we're going to be talking about that pretty soon as well. But so you see, you just scroll down this list here, and you got Texas Instruments, you got Advanced Micro Devices, Microchip Technology, all 44% of their total revenue, their total global revenue is from China. Intel, Western Digital, Corning, even Starbucks brings up the bottom of the list with 20%, and then China came in, or Apple came in right at the bottom of the list at 20% of its total revenue too. So very, mostly in the tech space here, but very distinctly American companies that are going to get hit as this trade war develops. Now let's talk about how to invest around all this, how to invest as this trade war develops into a Cold War, like I think it will. Next steps are, Trump and President Xi are scheduled to meet, or well, they're not actually scheduled yet. They're not even talking yet. They're saying they might meet at the end of June, which is the G20 meeting in Japan. If they don't meet, then that's all bets are off. If they don't put anything together for a meeting, then that's when this is really going to escalate badly, because both of these guys, they like to be the deal makers. They like to be the figureheads of this. What the consensus is right now is that they're kind of holding off so that they can come in, they can announce some kind of a deal or an agreement or even a meeting of the minds on at the end of June at the G20 to make each of them look good. That's very important obviously for President Trump with the election coming up, for President Xi, that saving face is very important as well. So they want to be able to come back to their constituents, and say, hey, I put this together. It was breaking down with a lot of our trade representatives, but I put it together. I brought it all back on track. They want to do that. If they're not able to do that, all bets are off, and it could get very ugly very quickly. But like I said, the consensus is that it's going to start thawing a little bit, and and they're going to be able to make some kind of an idea. Now that doesn't mean that tariffs are going to come off immediately and everything's going to be kumbaya again. You're still going to have some of these effects. So like I talked about, a little bit higher inflation, maybe a little bit lower earnings probably through the summer and probably into into the winter selling season even. So stock market's probably still going to be a little weak, even if it bounces back up a little bit on a thawing of the trade relations. But what I want you to look at is the longer term picture, okay? Because like I said, this is developing into a theme that is going to guide investments for decades. Okay, this is the next Cold War. If you look at it from China's perspective, and rightly so, they've had a horrible history with foreign interference. Okay, all the way back 200 plus years with the Opium Wars with England. Okay, basically, England, I love history. Okay, so I always look to history to understand where we're going. But if you look at the Opium Wars, a lot of people selling opium into China. China was cracking down because obviously it was creating a nation of heroin addicts. So they blockaded, or they took they they kept these companies from selling. Well, of course, these companies went to the English government and said, hey, we need this revenue. So the English government actually stepped in, blockaded the country, and basically took over China. That was when they got Hong Kong for that period. Basically took over the country, said these companies can sell whatever the hell they want into China, and basically it created an opioid epidemic. U.S. is going through its own epidemic right now. China went through it 200 plus years ago. 1 in 10 people in China, it was estimated 1 in 10 people were addicted to opium, and it's basically heroin. Okay, so they've got a history of this foreign influence that they obviously they want to guard against, and they're really hesitant about that. Also, the fact that is just that China is coming into its own. It's the second largest economy already, growing at about 6% plus a year, and compared to the U.S. Economy growing to about 2 to 3% a year. And while the U.S. economy is still very much larger, that huge growth in China means that they're contributing just as much to global GDP as the U.S. is every year. And actually, China is forecasted to exceed the U.S. GDP within the next 25 or 30 years. So they're obviously looking at taking their own type of control, at least within their sphere of influence. Okay, at least within the South China Sea, around Asia, that kind of thing. So the Chinese are in very much a very good position to be kind of flexing their muscles, seeing how far they can grow, and how much control they can have in their area. And of course, that's creating a conflict with the United States that has for decades, since the early 90s and the fall of the Soviet Empire, but even before that, has really taken up its mantle or its influence as police protector of the world, and that kind of control. And so what you're seeing is really the development of this next Cold War, where China is already having an amazing military buildup. And as we've seen over the past couple of years with President Trump's administration selling a lot of these arms deals. Anytime he goes to another country, Saudi Arabia, he made his first foreign visit because he wanted to lock in those arms deals, those military contract orders. So we're gonna start seeing an unprecedented military buildup. With Russia, we saw it before, but Russia really wasn't in the position to really extend and take that farther. China is very much in the position to be able to keep tit for tat with the United States in an arms buildup. So what I'd say, and this is one of the sectors that is going to benefit from this developing Cold War, is obviously that aerospace and defense industry. Okay. You've already got President Trump talking about a space force, talking about developing something like that. A lot of these other companies, but specifically those defense contractors like Lockheed Martin and Raytheon. Lockheed Martin is ticker LMT. I believe Raytheon is ticker RA. Okay, you've got the funds, ETFs, like the Aerospace and Defense Fund, the ITA, ticker ITA. Now that one's seen a little bit of weakness lately just because it holds Boeing. And we can talk about Boeing and some of their problems and how to invest in that as well in a little bit. But so this sector is very much going to be benefiting over this next decade at least with this Cold War with China, as well as just the the usual suspects. Middle East. Now we've got Venezuela as well. That is. Precipitating a military buildup and getting ready, not necessarily getting ready for war, but at least being prepared for it. So that is, defense and aerospace is a sector you want to watch over the next decade or more. I know a lot of people say, well, we're trying to get Europe to foot a lot more of the NATO military bill, stuff like that, but we're still very much going to be spending on these defense contractors. Another sector I want you to be watching is tech. and not necessarily the tech you might be thinking of, not necessarily U.S. tech companies, okay? Because how this trade war is evolving, like I said, we just got done blacklisting Huawei, or Huawei restrictions, where they can't buy from U.S. tech companies. So you've seen a lot of these Qualcomm, Broadcom, a lot of these companies just get smashed. Well, what's that gonna mean? China isn't gonna let a national champion like Huawei go under because of this. They are going to start favoring their own tech firms. It's going to be a tech renaissance in China, because they're going to be taking this tech that they've already bought, reverse engineering it, and creating their own industries that can really supply their own products and their own exports. So, the Chinese semiconductor, other tech providers might actually be getting a boost from this whole development. So I think you want to be watching some of those sectors in China through some of the funds. I know the GXC is a pretty well diversified Chinese fund that you might want to look at. And the story being here is that the funds are going to be hit by a little bit of bad sentiment here during the trade wars and as this develops. But like we talked about, this coming century, this is definitely China's advantage economically. So you cannot ignore that growing part of the world. What else do we want to talk about? Okay, I want to get to some of your questions, and I've seen a lot of questions come across the screen. If I didn't get to your questions, make sure you ask them again, because I might not see them. I'm trying to kind of scroll through and see what questions you had, but go ahead and okay, I see all good. Asked earlier, thoughts on oil prices, and this is something we've actually talked about in a couple other live streams. Oil prices are actually probably pretty good right now, because you've got Iran, restrictions on Iran, and that's escalating. Who knows if there's going to be some kind of a conflict or conflagration in the with the Straits of Hormuz and stuff like that. There's actually people talking about this was kind of how the war in Vietnam started, right? With a lot of the ships, the U.S. warships going towards that area, and the Gulf of Tonkin flare up there. So you've got Iran, which could try to cut off the Straits of Hormuz, which is a hugely important transportation zone for oil. You've got Venezuela, which is deteriorating by the day, and that is a very large exporter of oil. Libya has flare-ups. Right now, production out of Libya is actually pretty good and pretty stable, but they have perennial flare-ups with rebels and stuff like that. So basically, oil prices kind of have a floor of support on them right now, because global growth is still pretty decent. Obviously it's come down a little bit in the last few weeks with the trade war, but demand is still fairly consistent. But you've got these hot zones of oil where oil is being produced. That is the real question mark. So you've got that floor support on oil prices. Iran and Venezuela will keep that support, that limitation on production. And right now, it looks like Saudi Arabia isn't in any hurry to increase production. They're kind of dealing back channels with the Trump administration on keeping production a little bit low out of OPEC. You get any kind of a flare up in Libya or any of these other places, these big producers, and oil prices could go much higher. So I think you're probably pretty good with with oil prices and kind of oil related stocks. One of the reasons why I love MLPs right now, MLPs are those master limited partnerships. You get a huge tax benefit for these companies, and they pass back most of the profits to investors. It's kind of like the REITs of energy. And we've actually got a couple of videos on the channel about that, monthly dividend stocks and some of the highest paying dividend stocks. What else we got here? Looking for a few more questions. Oil stocks good for investment. We just kind of covered that. Utility energy stocks safe. Okay, actually, utilities are probably going to be one of the safer plays if you want to, if you want safety, if you're looking, like we said, if you're looking to get a little bit higher returns, and you can allocate into some of these other sectors that I think are going to do really well over the next decade or so. This defense and then maybe Chinese tech firms. There's some other. I actually really like the gold miners right now because you've got that safety as well as the dividend. But utilities are generally kind of a safety bet when the economy stagnates or when it falls and when a recession looks more likely. Now with utilities, you do want to understand really how much they're paying out, so that payout ratio as well as kind of the specific markets in which they in which they act. But with utilities and a lot of these higher yielding stocks, you've got the benefit of no more rising rates probably for the rest of the year. Whenever the Fed raises rates, then these high yield investments like utilities, like REITs, and like consumer staples, they tend to lag a little bit because of that competition with rates. But even if we do get a little bit more inflation on the on the trade war, I don't think the Fed is going to raise rates. They might not necessarily cut rates like that, like a lot of people think they will, but they're not going to raise rates. So you're probably good with utilities. What else do we have? How is this affecting index funds? Well, I mean, if you consider index funds like the broader market, the S&P 500, the Nasdaq, a lot of stuff like that. What you want to be worried about, and I know a lot of people love to invest passively in index funds because it's easy. It's kind of the easiest investment strategy you can go with. Just put your money in an S&P fund. The thing is, when you look at these the S&P 500, okay, and that's probably by far the most popular index fund out there, and we've talked about this on the channel before. Look at what it's holding in it, okay? If you look within the S&P 500 in that index, the proportion of that index, and you can do this with the index fund as well. 20 to 25% of that index is in tech stocks, okay? So there's going to be two things here. One is that as this trade war develops and as it becomes kind of a tech war as well, then that is certainly not going to be good for U.S. tech firms. Okay, we already looked at some of these companies, Qualcomm, Broadcom, Micron Technology, that have just gotten smashed because of the Huawei restrictions, and that's going to that's going to perpetuate itself and keep going. So within these index funds, you've got a very large proportion is in tech. But also, tech is just more cyclical than other sectors. So even if we come off the trade war doing fairly well, but earnings are coming down a little bit because of these tariffs, and the economy falls a little bit, tech is going to get hit harder than a lot of these other sectors. So you're kind of damned if you do, damned if you don't with tech. A lot of that. So these index funds, yes, they will be affected, and probably more than you might think. What else? What else we got here? Okay, GE. Can anyone actually own Chinese stocks? Isn't there some kind of... Well, yeah. I mean, with Chinese stocks, usually you have to go through either ADRs, which is a Chinese company listing on a U.S. exchange, which a lot of your larger tech companies are. Your CHL, your China Mobile, your LFC, which I own the LFC, which is China Life in our 2019 stock market challenge. But you've also got funds, and the funds, the ETFs are the best way to hold some of these smaller Chinese companies that aren't necessarily investable in U.S. firms or as from U.S. investors in those U.S. exchanges. So you've got the GXC, which is and I just want to make sure I've got the right ticker for you there. So I'm going to look that up real quick on Yahoo. But I believe the GXC is the China fund, probably the most popular China fund after the FXE, or the FXI, excuse me. Yep. So the Spider S&P China ETF, the GXC, and why I say that, even though I own the other China fund, the FXI, which is the iShares China Large Cap ETF. Now, I own the FXI in our 2019 stock market challenge, that dividend stock portfolio that's actually up around 20% for the year against a 13-14% gain on the S&P 500. So beating the market there. But we own the FXI just because a lot of what I'm looking at is a lot of these the stimulus measures from the Chinese central bank are easy loan rates, extra loans, things like that going out to China financial companies, okay? So obviously the first to benefit from those are going to be these large financial institutions in China. Okay, and that is, if you look at the companies that are held in the FXI and the companies that are held in the GXC. Okay, the FXI is much more a financials investment. Okay, you've got all the big banks, you've got all the lenders, all that in the FXI at a much bigger proportion. So if you're looking at the banks and the insurance companies and things like that doing well in China first, then you're going to be in the FXI. Now, what I would say though is for this longer term play is to be in the GXC, which is a little bit more diversified outside of the financials for Chinese financial companies. So it's going to have more in tech, it's going to have more in consumer goods and retail goods and stuff like that. So those are two ways to invest in China. Now, if you can open up, there are some brokerage firms, some larger brokerage firms that can invest in China mainland companies and give you a piece of that. It tends to be a little bit higher net worth brokerage firms a lot of times, but I would just go for those ETFs and the individual stocks. So what else do we have? Any idea about building passive income with Forex trading? And does always need a broker to start trading Forex? I mean, you will need a broker to trade any kind of futures, commodities, Forex, anything like that. You're going to need a broker because the broker is going to be the one that's going to make those trades on the exchange. I mean, you don't have a seat on the exchange. So you need to go through a broker. Most online investing platforms will do it. I trade through Ally Invest, through E-Trade. Most of these will set you up with a foreign exchange or a futures account that you can trade. And yeah, I mean, I've been a futures trader, and it's interesting. It's fun, but you cannot do it as an amateur. Okay, the futures trades 23 hours a day. It's not closed like a stock market, so you will find yourself waking up at 2 in the morning, wanting to see how the most recent Chinese economic data came out. That's going to affect your, especially the Forex. With the foreign exchange market. So I would make sure that you're ready for that. Make sure you're ready to make it an actual job of following these currencies and where you think they're going to go. Ruben asks, this Cold War talking about, does it affect 3M? I haven't seen what percentage of 3M sales are in China, so it would certainly affect it in that respect if they have a large portion of revenue. I think GM is more a U.S. firm as far as U.S. revenues, U.S. sales, or North American sales. So maybe not quite as much in that view, but it's going to be affected by the general slowing of the economy in the shorter term. Certainly, I think without looking at 3M and where their sales are coming from, it's a fairly well diversified conglomerate. So I would think they're going to do a little bit better than some of these other companies that have get a larger percentage of their sales from China. What happens if you put an MLP into an IRA? It's a great question, Daniel. I'm glad you asked that. It's something that I talk about every once in a while because a lot of people have that question. Do not hold your MLPs in an IRA. Okay, that's the easy answer. Here's my retirement investing strategy, and this is probably some of the best advice for retirement investing you can get. Okay, hold your high dividend stocks, your high dividend yielding stocks, your bonds, your real estate investment trusts, so your REITs, hold those in an IRA, a Roth IRA, any of those tax advantage accounts, right? Because otherwise you're getting those dividends each year, each quarter, and you're going to have to pay taxes on that investment every year. Okay, you're going to lose some of your dividends to taxes every year. Now, MLPs are different though, and one thing you can do if you want an MLP and you want those tax advantage benefits there is you can buy the Alarian MLP fund. That's the AMLP ticker symbol. We actually have that as well in our 2019 stock market portfolio, which is in an IRA account. I've got that in a Roth account, so I don't have to pay any taxes each year on those investments or on those dividends. But the fund is a little bit different. If you have individual MLPs, so holding individual stocks of these companies, so we're talking, EEP, KMP, I think is still technically an MLP. A lot of these individual companies, you don't want to hold those in an IRA. Okay, you want to hold those in a regular taxable account because the way these are accounted for on your taxes is different. Okay, you'll receive a K1 form visa or a K1 form each year for your taxes. And a lot of people are turned off by this, but it's a great tax benefit. What happens with these MLPs is, okay, so say you get $1 dividend each quarter from these MLPs. Now, a majority of that dividend, maybe 80% a lot of times, so 80 cents out of that dollar is accounted for as a return of investment. Okay, so you paid $25 for this MLP. They send you a dollar dividend. 80% of that is a return of your investment. So that $25 you paid for it on a tax basis actually comes down to $24.20. Okay, so it's not actually a dividend you received. It's just them giving you some of your investment back. Okay, you still own the same amount of shares and everything. Now, when you sell those shares, then that capital gain that you have, that gain is from the price you sell it and that $24.20 now. So it's not the $25, it's come down from that dividend you received. So you pay a little bit more taxes when you sell those MLPs, but you don't have to pay all those taxes on the dividends each year you collect them. Well, obviously if you put that in an IRA where you don't pay taxes anyway, you lose that benefit. So you want to hold those individual MLPs in an IRA account, take that tax benefit, and then never sell your MLPs. Okay, if you never sell them, you'll never have to pay that increased capital gains tax when you sell them. And the great thing about MLPs, this is why I own so much in MLPs also, is that if something happens, if you pass those MLPs on through an estate to your heirs, that price gets marked up, and they will never pay taxes on that gain. Okay, you pay $24.20, let's say, on that MLP. Let's say it rises to $50. You pass away, and it's trading for $50. It goes to your heirs. Their new value is $50. So they'll pay taxes on anything above the 50 when they eventually sell those MLPs, but they won't pay taxes that you owed from that $24.20 to the $50 or to the $50. Okay, so it's great investment, great way to take advantage of your taxes. And like I said, when I worked with private wealth clients, that's the biggest way that they made money is through tax strategies like this. So what else? What happens if you put, how will it affect gold? Will it be wise to put funds in gold and silver even though both are not considered an investment? Another good question, Jim. I haven't quite seen a lot from gold lately. And a lot of it is just because inflation hasn't picked up like everybody thought it would be doing. But like I said, I do think we're going to start seeing more inflation numbers come through, especially on the retail side. So that is definitely going to help out the price of gold. Some of these other precious metal commodities. Now, I generally don't like holding actually holding the commodities. So holding physical gold or silver. I do some futures trading where I trade the futures price on gold and silver, but of course I'm not holding it for more than a couple of months, and I'm trading more on the price. But I don't hold physical commodities because it just doesn't pay anything. You actually lose money because your insurance on it, your holding fees, all that kind of stuff. So I usually like the miners instead. And granted, a lot of the gold miners, a lot of the commodity miners haven't done much over the last few years because those prices haven't gone much. But I think it's a good safety play. If you are worried about the stock market, worried about the trade war and the coming Cold War, then I think it can be a good part of your portfolio. So CD wants to know what if credit preparer and good companies for a secured credit card, when to pay your monthly, what percentage you should pay that total debt, any interest on that. I mean, that's a whole nother topic we could go into. If you want to leave a comment on one of the other videos, then I can go a little bit more into all that. With credit, so when to pay your monthly, you should actually. I always like paying it bi-monthly. So get all your credit cards and pay it every 2 weeks, okay? And what this does is when credit cards charge you interest, okay, they're not charging you interest on what you still owe at the end of that month. They're charging you the average balance, okay? So you could actually pay off all but $1 on your credit cards, and if you still owe $1 at the end of the month, then they're going to charge you what that average balance was throughout the whole month. So what you want to do with your credit cards is hopefully you can pay them off. If you can pay them off, you won't owe any interest. But if you don't think you can pay off your credit cards in full each month, then you pay it every week if you can. There's a lot of companies do direct deposit from your bank. You can make a payment every week, even if it's just a few $100s. But yeah, pay it as soon as you can, every week or every 2 weeks, and that's going to reduce your average, your average balance. Okay, it's the average daily balance, right? So that's going to decrease that throughout the month. If you still owe money at the end of the month and you do have to pay interest, you're going to pay a lot less interest on that. How about some commerce companies? Alibaba, JD, Amazon. Yeah, I do actually kind of like Alibaba, and I haven't looked at the price chart in a while. I was in it a couple of years ago when it was down around 80 and sold out at 120, and I think it's actually much higher now. But Alibaba is the Amazon of China and really expanding out into the rest of the world. Alibaba is, if you don't know, Amazon FBA, which is basically companies buying products in China, shipping them to the U.S., and then selling them through Amazon. It's usually through Alibaba. And Alibaba actually just announced within the last month that they're expanding their platform, so manufacturers in other countries can sell through the platform. So that's going to be a huge boost to Alibaba, and I think it's something that that's going to be one of the companies that 10 years from now you wish you had some money in, because it is growing, and it's going to be a real competitor for Amazon, I think, for the rest of the world. Maybe not so much for the U.S., but for the rest of the world. Some of those other domestic Chinese IT companies. It's hard because a lot of stuff is really expensive now. I'd say China's probably one of your few value opportunities around the world as far as stocks. Obviously U.S. stocks are still very expensive even after the sell-off. So, you can start looking at some of these Chinese companies and putting them in your portfolio. And taking advantage of that. Like I said, we have some of those stocks in our 2019 Dividend Stock Market Challenge portfolio, and they've done really well. Even after the sell-off since May, I think China Life is up over 25-30% on the year. So twice as well as the regular market, even after that sell-off. Who else do we have here? Like the way you speak, live, scripted. Can't see effect. Okay, I can't see it affecting American real estate investments. Just to ask, will what's going on now internationally with trade affect American? Well, okay, it's a good question. It's actually kind of the question we were talking about in that comment we highlighted, is that one, it's generally the economic effects. Okay, if the economy does slow, and actually J.P. Morgan just updated their U.S. economic growth forecast for the second quarter. So their forecast for the second quarter has now come down to 1%. They're forecasting that the U.S. economy, they were forecasting, I think, 2.6% for the quarter. Now they're saying it's only going to grow 1%. So the economy is certainly slowing down. These tariffs, the trade war isn't going to help. We were talking about an earnings recession with companies. So what you're going to have is that general economic slowing. And what you're going to get is, like I said, a lot of these REITs that you look at. So you've got office, you've got hotel, you've got industrial, you've got self-storage, you've got data, digital storage REITs that are big. Some of those sectors are very much more cyclical than others. So if you start seeing companies laying off, if you start seeing retail sales coming down because of that inflation, because of the tariffs, because of the general slowing in the economy, then yeah, you're going to start seeing, office. You're not going to need as much office space. Companies aren't. So that's going to come down a little bit. Industrial manufacturers certainly aren't going to be producing as much. People aren't going to be traveling as much. So hotel REITs, your retail REITs, which have been just slammed over the past decade anyway, with kind of the death of the shopping mall and that kind of thing, they're not going to be doing quite so well either, because obviously people are having to pay more for what they want to buy. So retail sales could be coming down. So again, sectors of the real estate economy could get hit. So it's maybe not directly affected, but you got to understand also, China, over the last decade or so, China has been a big buyer of U.S. real estate. A lot of we see a lot of these problems with the Chinese yuan, their foreign currency, weakening. And that's because a lot of these new rich, these Chinese billionaires and millionaires that are coming up in this Chinese explosion, in this Chinese growth story, are taking their money out of China, investing in U.S. real estate, kind of like what we saw in the 80s with Japan. So if you don't get that kind of foreign investment from China into U.S. properties, then that's going to be another another burden, another thing that's going to hold it back. What else we got? Thought on Alibaba. Yeah, we just talked about Alibaba again. I think it's a solid long-term stock. Obviously, headline risks are gonna hit it, but I think it's one that you can kind of leg your investments into. I haven't looked, like I said, I haven't looked at the stock price lately or the valuation on it, but I think you can leg into it and be good over the long term. What else do we have? What do you think of Uber's IPO? Now, this is actually, thank you, Austin. Thank you for asking that. I've really been wanting to do an IPO a video, and I'm putting one together because when I worked for venture capital, this was a big part of what I did analyzing IPOs for investment. Developing those price estimates on them and stuff like that. Now, the short answer is I would never recommend investing in an IPO. Unless you can get in pre-IPO. A lot of times that can pay off sometimes, but if you're just on the day the shares become public, if you're just investing at that point, it's almost always uniformly a bad decision. And why I say that is because guys like me in the venture capital space, we were doing our analysis and pre-selling this IPO and all the private equity and VC investors before, they've kind of sucked all the value out of those stocks. Okay, by the time the stocks get public, you've got all the value sucked out of it. Okay. I'm working with billion dollar hedge funds and stuff. They don't want to leave any money on the table when that stock goes public. They've invested in this company for 5-10 years and they want to squeeze everything out they can. Now, what I will say is that, and in this video, I'm going to show you ways to understand how much that stock's actually worth. Okay, ways to compare it to other stocks, ways to compare it against its own value, and figure out what that price is that it is a good investment. So typically when the share price does come down after the IPO, and that's almost uniformly what you see a lot of times is you saw it with Uber, you saw it with Lyft, you saw it with Facebook. Facebook came out to like I think came out like $24, immediately went up to like 42 over those first few days of the IPO, and then came all the way down to 18 within 3 or 4 months, I think, if I remember right. So I'm going to show you how to actually value where is a good price to start investing in those. A lot of times when a stock IPOs, then a lot of the early investors will be in what's called a lockup period. So they can't just immediately dump all their shares and take their profits on the market. But as that lockup period expires, and it does so over a period of months and years, then you've got all this money or all these shares coming back onto the market, and that tends to depress the stock price. So generally, yeah, I wouldn't say jump in on an IPO as soon as it starts trading. Develop a fair value for that stock, what you think it can be worth, and then wait for it to come down to that point. That said, I do love some of these Uber, Lyft, some of these self-driving or these ride-sharing companies because they're on the forefront of this self-driving technology, and that is going to be besides this China Cold War theme, I think that self-driving technology is going to be one of the biggest themes that you can watch for over this next decade. It is going to mean huge implications for business, especially the trucking companies that pay upwards of a third or half of their costs go to driver costs. They're going to be saving all that money. A lot of these other companies, even Amazon, that's got huge distribution costs, is going to be saving big money. So when this self-driving technology becomes viable, and they've already had cross-country trips in trucks where there was a person behind the wheel but they never touched the steering wheel. So this is already becoming viable, and it's going to be one of the biggest themes over the next few years or decades to invest in. What else? Have any thoughts on China railway companies? Some out there, great value. Don't see a war. Yeah, I haven't looked at China Rail in a while. I haven't looked at that. Generally, like I said, I do like some China stocks, and I think you can leg into them even against this trade war, just because China is going to be trying to develop its own industries even more so now that it knows that the U.S. can just cut off its companies. the Huawei moment was really, and I saw some people talking about it earlier. The Huawei moment was China's Sputnik moment, and if you remember back in the back when Russia had Sputnik go up, it really launched the space race and really drove, ended up driving a U.S. astronaut to the moon because it was a real wake-up call. And I think this Huawei restriction, the blacklist, is going to be the wake-up call for China that it needs to develop its own, especially its own tech input companies. It can't rely on Qualcomm, Broadcom, Micron, a lot of those companies anymore for those tech inputs. It's going to have to develop its own national heroes with that. So yeah, a lot of these Chinese companies could do well. What else? Tesla. I knew somebody would ask about Tesla. Tesla really scares me. I mean, I know it's made a lot of people a lot of money, not so much over the last year, and I'm generally not a big believer in growth stocks. Okay, Amazon's been one of the rare exceptions that I love, and it's perennial. It's perpetually a growth stock. Tesla, the problem is, it is trading on a price to earnings multiple so far out in advance of what it is making right now. And all these other car companies are catching up. I mean, it makes quality cars. I understand that. I understand a lot of people really love its cars. It's got a lot of brand value in that. But eventually, if you look at something like Ford or GM, Ford I think is trading at maybe a 7 or an 8 times price to earnings multiple. And I haven't checked Tesla's for a while, but it's not even profitable in most of its quarters. And sorry about the noise here. So Tesla, eventually that price to earnings multiple is going to have to come down to some of these other traditional manufacturers. And that might not be fast. It might happen over many years, but it's going to happen. And that is just going to be a very hard, kind of a ceiling on the stock price. It's going to be hard for the stock price to overcome that. So, I mean, is it something for speculators? Can you make a lot of money in it? Sure, because I have no doubt that there will be bounces in it. With different cars. But Tesla, I mean, all the trade wars and the problems in China aside, but that is really going to affect Tesla as well. They really pinned a lot of their growth hopes on China, which isn't helping any right now. But even all that aside, it's going to be hard. It's a tough stock to make money in. What else? We're coming up on an hour and 11 minutes, so I want to wrap it up here. Pinterest is one that I use a lot, but they really need to figure out their revenue model. I look at Pinterest a lot like I looked at Facebook when they IPO'd. Facebook, they still hadn't developed their revenue model, how to make money from the platform. You saw the shares drop all the way to $18, and then now it's like $200 or something. So many times over. So I think Pinterest, look at where it goes. Maybe see some of the hype come out of it a little bit after their IPO and pick up a few shares and maybe hold on to them for a while, because it is a legitimate social media platform and they are doing well. I want to thank everybody for being here. Like I said, we do these every week, every Sunday at 1 p.m. Eastern. Love the opportunity to connect back and forth with all of you in the community, answer your questions and talk about some of these subjects here. Do me a favor, hit that like button or go watch, see some of these other videos that you might enjoy and share them. We're actually almost to 75,000 subscribers, which is really exciting, those milestones for subscribers. And obviously, what that does is the more subscribers, the more we get to share the videos with people on YouTube. The more YouTube says, okay, higher subscriber base, more people watching, we're going to kind of expand that community. And we've really been able to grow this community just in the last 18 months. I started 18 months ago, and up to 75,000 of you out there that really care about creating your financial future. So I appreciate that. I love seeing the comments on the videos. Like I said, check out this week's videos. We've got coming up some great ideas in personal finance, and the week after that, we've got some great videos coming up on dividend investing. So thank you. I appreciate you being here, and until next Sunday, thank you.